In our last video, we told you the truth. 90% of investors lose to the market. Behavioral biases, high-frequency traders, the concentration problem, market timing. The deck is stacked against you in ways most people never see. And we gave you the solution. Buy the index. Low cost, diversified, time in market beats timing the market. We were right, but we weren't giving you the full picture. Because here's what we didn't tell you. The index itself might be broken. To understand what's happening, you need to understand what happened over the last 25 years. At the turn of the century, passive investing, index funds, ETFs, represented about 15% of the U.S. funds market. Most money was actively managed. Professional stock pickers, research analysts, humans making decisions about which companies were worth owning. John Bogle had already launched the Vanguard 500 Index Fund back in 1976. People called it Bogle's Folly. Who would want average returns? Turns out, almost everyone eventually. Because the data started coming in, and the data was brutal. Active managers underperformed their benchmarks, again and again, year after year, decade after decade. Why pay someone 2% a year to underperform? So the money moved. Slowly at first, then all at once. A key inflection point came in 2006 when the federal government essentially gave index funds a structural advantage, designating them as the default investment for automatic 401k enrollment. Hundreds of millions of Americans started having money pulled from their paychecks and routed, automatically, on autopilot, into index funds. By the end of 2025, passive funds held $19.4 trillion in assets. That's 55% of the entire U.S. funds market, more than half, and it's not slowing down. Active equity funds saw more than $500 billion in outflows in 2025 alone, part of a $3.2 trillion exodus over the past decade. Think about that. $3 trillion pulled out of active management and sent into passive vehicles in 10 years. Now here's where the poker metaphor becomes important. When everyone at the table is playing the same strategy, buying the same index in proportion to market cap, no questions asked, something fundamental changes about how the game works. And when everyone's playing the same hand, the risks are no longer individual. They're systemic. Let's look at what you're actually buying when you buy an S&P 500 index fund today. You think you're buying 500 companies, diversified exposure to the American economy, the whole market. You're not. You're buying a portfolio where 7 companies, Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta, and Tesla, the so-called Magnificent Seven, represent roughly 1/3 of everything. The 10 largest companies? They now account for over 40% of the entire index. Let that sit for a second. You bought 500 stocks. 40% of your money went to 10 of them. Now, you might say, okay, but these are massive, successful companies. Apple generates $300 billion a year in revenue. Nvidia is transforming the entire technology sector. Maybe concentration in great companies isn't a problem. And that's a fair point. We'll come back to it. But first, let's put this in historical context. The peak of the dot-com bubble in 2000, one of the greatest periods of speculative excess in market history, the top 10 stocks made up about 27% of the S&P 500. Today, we're at 40%. Between 1880 and 2010, the historical average was around 24%. We are in historically unprecedented territory. And here's the number that really gets me. Researchers at Bridgeway Capital Management ran the math on something called the effective number of stocks in the S&P 500. Basically, when you account for how concentrated the weightings are, how many stocks are actually doing the heavy lifting? The answer? 46. Out of 500. That's the lowest it's been in 55 years. Less than half what it was in the 1990s. Less than during the Nifty 50 craze of the early 70s, which, for those who don't know, ended very badly. Think about what this means at the poker table. You thought you were holding a full deck, 500 cards. Instead, you're playing with 46, and 7 of those cards, the Mag 7, represent 1/3 of the entire game. The S&P 500 also traded at a cap-weighted PE ratio of about 27 times earnings at year-end 2024. The equal-weighted version? 13.8 on the Russell 2000 value. The valuation gap between the largest companies and everything else is near a record. That's not diversification. That's a highly concentrated bet on a handful of mega-cap technology companies, packaged as a safe index fund. Now let's talk about the mechanics, how passive investing actually works when things go wrong. When you buy an S&P 500 index fund, here's what happens. The fund takes your money and buys shares of every company in the index, in proportion to their market cap. No analysis, no judgment. Big company gets more money. That's it. What this means is, the largest companies get a disproportionate share of every dollar flowing into the market. Apple is 7% of the index. 7 cents of every dollar you invest goes to Apple, whether it's overvalued or not, whether earnings are growing or shrinking. The fund doesn't care. It just buys proportional to size. Michael Burry, the investor who famously predicted the 2008 financial crisis and was the subject of The Big Short, called this out publicly. He compared it to the subprime CDO bubble. Here's why. In 2008, CDOs were pooling thousands of individual mortgages, including terrible ones, into a single product that got a AAA rating. The individual risks were hidden inside the bundle. Nobody looked at the underlying assets. Burry's argument is that index funds are doing the same thing. You think you're buying 500 carefully selected companies, but you're really buying whatever's biggest, regardless of value, regardless of risk, because the mechanism forces it. In a recent interview, he said, "Today, over 50% is passive. Less than 10% is actively managed by people who are really thinking about the stocks. Now I think the whole thing is just going to come down." And there's hard academic data supporting the underlying concern. A landmark 2021 study by Haddad, Hubner, and Leach, published in the American Economic Review, found that the rise of passive investing over the previous 20 years had made demand for individual stocks 11% more inelastic. What does inelastic mean in plain English? It means markets respond less to new information. When a company reports bad earnings, or faces a major lawsuit, or has a fundamental problem, a market with healthy price discovery would see sellers step in, repricing the stock lower to reflect reality. But with passive flows dominating, the price adjustment is slower, smaller, and less reliable. Michael Green, chief strategist at Simplify Asset Management, who manages $12 billion and has studied this mechanism in depth, put it this way. When you switch to passive investing, you're adding more money to things that simply went up. You kill the mean reversion that is central to all models of how markets function. Price discovery, the market's ability to signal when something is overvalued or undervalued, gets progressively weaker as passive grows larger. But here's the other side of the mechanics equation that almost nobody talks about. The forced buying creates the bubble. The forced selling is what pops it. When the money flows out, whether it's a recession, a crash, or just people retiring and drawing down their accounts, the index fund must sell. Proportionally. No judgment, no discretion. It sells the same stocks it was automatically buying, the largest ones, in the largest amounts. This creates a mechanical amplifier. A market that already had trouble pricing accurately now can't stop itself from selling what it already couldn't stop itself from buying. That brings us to the next hand being dealt at this table. 75 million baby boomers. That's how many Americans were born between 1946 and 1964. They will all be seniors by 2030. The last of them hit retirement age in the next few years. For decades, this generation has been the dominant force driving money into the market. They saved, they contributed to their 401ks, they bought index funds. Every paycheck, a portion flowed in. Now they're retiring, which means the flow reverses. At the end of Q1 2023, according to Yardeni Research, baby boomers held $74.8 trillion in net worth. The single largest asset class? Corporate equities and mutual funds, over $20 trillion. When a retiree needs to pay for living expenses, they sell. When they sell ETFs and index funds, the fund has to sell the underlying stocks, proportionally, automatically, no questions asked. This demographic wave doesn't require a crash to cause problems. It just requires time. The math is unavoidable. A generation that spent 40 years as the primary buyer of equities is transitioning to becoming the primary seller, and they're doing it at the exact same moment that passive strategies have made markets less capable of absorbing large, one-directional flows without amplifying the move. We've never seen a demographic shift of this magnitude hitting a market this concentrated and this passively driven at the same time. This doesn't mean the market crashes next year. Demographic trends operate on decade-long timeframes, but it does mean the structural tailwind that helped push markets steadily higher for 40 years is gradually and inexorably turning into a headwind. Okay, I've been building a bear case here. Let me steelman the other side, because this is where intellectual honesty matters. The counterarguments are real, and they're strong. First, active management still fails. Yes, markets are more concentrated and more passively driven than ever, but in 2025, only 38% of actively managed funds beat their passive counterparts. Over 10 years, only 21%. Knowing the concentration problem exists doesn't help you if your alternative, paying an active manager, statistically loses anyway. Second, the fees argument still holds. A typical active mutual fund charges 1 to 1.5% per year. Over 30 years, that fee drag compounds into a catastrophic difference in terminal wealth. An index fund at 3 to 5 basis points is still mathematically superior for most investors over most time horizons. Third, concentration in quality might be justified. The Magnificent Seven aren't dotcom-era pets.com. These are companies with trillion-dollar revenues, dominant market positions, mountains of cash, and genuine competitive advantages. Apple, Nvidia, Microsoft, these are the most profitable companies in human history. The concentration reflects real economic dominance, not pure speculation. Fourth, you can't time it. And here's the hardest truth. Even if everything we've described is accurate, even if the structural risks are real, nobody can tell you when it matters. The S&P 500 returned 17.9% in 2025. The person who sold the index because of concentration risk in 2023 missed 26%. In 2024, they missed 25%. In 2025, they missed another 18%. Time in market beats timing the market. That remains true. So where does that leave us? Here's the honest answer. Index funds are still probably the right choice for most investors. The risk is real, but it's structural and slow-moving, not a tomorrow morning problem. What is a problem is blind faith. Owning an S&P 500 fund without understanding what's actually inside it, what the risks are, and what your plan is if a prolonged drawdown hits, that's where investors get hurt. You're not at the wrong table. You might just be playing the wrong way. So let's talk about what you actually do with this information. What does a smart player do when they realize the table is different than they thought? Play 1. Know what hand you're actually holding. Before anything else, go look at what's in your index fund. Seriously, log into your brokerage, pull up the holdings, and look at the top 10. If you own a standard S&P 500 fund and 40% of your money is in 10 tech companies, that's not diversification. That's a tech bet with extra steps. Understanding what you own is the foundation. You can't manage risk you don't see. Play 2. Consider equal weight alternatives. An equal weight S&P 500 fund, like RSP from Invesco, gives each of the 500 companies the same allocation rather than weighting by market cap. The Mag 7 goes from 1/3 of your portfolio to about 1.4%. The equal weight index actually outperformed the cap weight S&P 500 by about 1.5% per year from 2003 through 2022. The last 3 years, it lagged significantly as megacaps dominated. but that gap in itself is a signal about how extreme concentration has become. Bridgeway's research also points to the equal weight 50 largest companies as a middle ground. You keep large cap quality and liquidity, but reduce the Mag 7 from a third of your portfolio to about 14%. Play 3. Diversify internationally. Here's something most U.S. investors get wrong. You think you're diversified because you own 500 U.S. stocks, but that's 500 stocks in one country, in one currency, in one regulatory environment. The rest of the world is trading at a significant discount to U.S. valuations right now. International developed markets, Europe, Japan, are trading at PE ratios in the 12 to 15 range. Emerging markets lower still. If mean reversion is coming, it likely comes first by the rest of the world catching up rather than U.S. stocks collapsing. Adding a 20 to 30% allocation to international index funds isn't unpatriotic. It's basic table management. You don't put all your chips on one bet, even if that bet has been winning. Play 4. Keep some cash for when the music stops. Here's the upside scenario from everything we've described. If the concentration unwinds, if Mag 7 valuations correct, if boomers selling creates a prolonged drawdown, that's not only a crisis, it's an opportunity. Having 5 to 10% in cash or equivalents isn't about timing the market. It's about having dry powder to add when valuations reset. The investors who come out ahead of a crash are usually the ones who had cash ready to buy when everyone else was selling. As Charlie Munger used to say, the big money isn't made by buying or selling, it's made by waiting. Play 5. Understand the narrative arc. Here's the meta point. The story of markets is always the story of a dominant strategy working, attracting more capital, becoming crowded, developing structural fragility, and then, eventually, reverting. Value investing dominated for decades. Growth investing dominated after. Active management dominated until it didn't. Passive investing has dominated the last 15 years. None of these cycles last forever. The passengers who understand what cycle they're in and why it might change are the ones who don't get wrecked when the table reshuffles. You don't need to be the first one out. You don't need to time it perfectly. You just need to not be the last one at the table thinking the game is still the same game it was. Let me leave you with the bottom line. Index funds are not the enemy. They are still the single best tool available to most long-term investors. The evidence on fees, simplicity, and consistent outperformance over active management is overwhelming. But there is a difference between index funds and blind faith in index funds. The blind faith version says, set it and forget it. The S&P 500 always goes up. I'm diversified. I don't need to think about this. The smart version says, I understand what I own. I understand the concentration, the structural mechanics, the demographic trends working in the background. I have a plan for how I'll respond to different scenarios, and I'm not going to be surprised when the market eventually does what markets always do. In poker, a flush draw isn't a bad hand. It has real equity, real potential. But experienced players don't play a flush draw the same way they play a made hand. They know the risk, they know the odds, and they manage the position accordingly. That's the difference between an investor and a gambler, not which instrument you use. How well you understand what you're actually holding. If you want to go deeper, our last video covers the behavioral and structural reasons why most investors underperform in the first place. That's the foundation this builds on. Link in the description and pinned in the comments. And if this video changed how you think about what's inside your portfolio, share it with someone who just defaulted into their 401k and hasn't thought about it since. Subscribe if you want to keep reading the table. We'll see you next time.